Topic examines the uses and sources of intraday liquidity, which refers to funds available to financial institutions during the business day to meet payment and settlement obligations in real time. Banks require intraday liquidity to process customer transactions, settle securities trades, satisfy margin requirements, and support payment system activities. Unlike longer-term liquidity management, intraday liquidity focuses specifically on timing differences between incoming and outgoing cash flows within a single operating day. Payment systems, central counterparties, and financial markets depend heavily on the smooth availability of intraday funds. The topic emphasizes that inadequate intraday liquidity can disrupt payment systems, damage market confidence, and create broader systemic financial instability. The topic explains that financial institutions obtain intraday liquidity from several important sources. Central bank credit facilities are primary sources because they provide temporary funding support against eligible collateral during operating hours. Banks also rely on incoming customer payments, maturing transactions, interbank borrowing arrangements, and liquid asset sales to meet intraday obligations. Collateral management plays a critical role because secured funding mechanisms often determine how much liquidity institutions can access during stressed conditions. The topic highlights that institutions operating in multiple currencies and jurisdictions face additional complexity because payment timing, settlement systems, and funding markets differ significantly across regions. Effective coordination of these sources is therefore essential for maintaining operational continuity. Intraday liquidity is heavily influenced by payment system structures and settlement mechanisms within financial markets. Real-time gross settlement systems require immediate settlement of transactions, increasing the demand for intraday funds because obligations cannot be deferred or netted extensively. Securities settlement systems, derivative margin requirements, and foreign exchange transactions further intensify liquidity demands throughout the day. Delays in incoming payments can create significant liquidity pressures even for otherwise financially sound institutions. The topic emphasizes that operational disruptions, technological failures, or market stress can amplify intraday liquidity shortages rapidly. Consequently, institutions must maintain adequate buffers and continuously monitor payment flows to avoid settlement failures and operational disruptions. Topic also focuses on managing and measuring intraday liquidity risk, which involves ensuring institutions can meet payment obligations on time under both normal and stress conditions. Intraday liquidity risk arises when expected cash inflows fail to arrive as scheduled or when outgoing obligations exceed available funds temporarily. Effective management requires accurate forecasting of payment flows, monitoring account balances continuously, and maintaining sufficient high-quality liquid assets or collateral. Institutions also establish contingency funding arrangements and operational controls to address unexpected disruptions. The topic highlights that intraday liquidity management is critical because payment delays or settlement failures can spread quickly across interconnected financial institutions and markets. A major aspect of intraday liquidity risk management involves measurement tools and monitoring indicators that identify emerging vulnerabilities throughout the business day. Institutions track payment timing patterns, peak liquidity usage, collateral availability, settlement exposures, and concentration risks across counterparties and currencies. Stress testing frameworks evaluate the impact of delayed payments, operational disruptions, market volatility, and counterparty failures on intraday liquidity positions. The topic explains that regulators increasingly require banks to collect detailed intraday liquidity data to improve transparency and strengthen payment system resilience. Measurement systems must therefore integrate operational, market, and funding information to provide timely insights into evolving liquidity conditions and potential settlement pressures. The topic concludes by emphasizing the systemic importance of effective intraday liquidity management within modern financial systems. Because payment networks and settlement systems are highly interconnected, liquidity disruptions at one institution can quickly affect other participants and destabilize broader markets. Financial crises have demonstrated that even temporary payment delays can undermine confidence and intensify systemic stress. Institutions are therefore encouraged to maintain strong governance structures, advanced monitoring capabilities, robust operational infrastructure, and diversified funding arrangements to support intraday liquidity resilience. Regulatory initiatives such as Basel monitoring frameworks further reinforce these objectives by promoting standardized measurement and reporting practices. Ultimately, sound intraday liquidity management supports financial stability, market confidence, and efficient payment system functioning.